welcome to It's the Economy. Much more than the equity markets, the global currency and bond markets have been in a tizzy since the election of Donald Trump. The dollar index rose from a low of 103.3 on November 5th, day before election, to a high of 107.5 on November 22nd, a gain of 4% in 2 weeks, very big for currency markets. In a mirror action, the rupee fell from 84.1 per dollar on November 5th to a low of 84.5 per dollar on November 22nd. It's recovered just a bit. We are still pushing 84.5. In more recent news, Trump has threatened only a 10% tariff on China, but 25% on Canada and Mexico. Even more important for markets, on November 22nd, the day the dollar peaked off, he named a fiscal hawk, Scott Bessent, as his former Treasury Secretary, as his forthcoming Treasury Secretary. Bessent has previously vowed to bring the US fiscal deficit down to 3% from the current around 8%. Now, Asian currencies have since recovered after this expectation of Bessent bringing down fiscal deficit, but there's still mayhem. What can we look forward to in terms of currencies, US yields, FPI flows, Indian rate cuts and yields? I have with me a master of the currency and bond markets, Sameer Goel, Global Head of Emerging Markets and APAC Research at Deutsche Bank. Sameer, good morning, and thank you very much indeed for sparing time. Well, first up, this currency point itself, we saw that 107.5 on November 22nd, but after the announcement of Scott Bessent, we have seen dollar give up a bit. So can we say dollar's peaked for now?
Morning, Latha. Look, I mean, let's look at the big picture. I mean, to my mind, the mix of policy which the incoming administration in the US will likely adopt, and certainly has been what it has been projecting through a lot of the conversations in and around the campaign. And since then, the cast of characters which has been chosen mostly, to me, validates the argument that this policy mix is going to move towards something which will widen out the gap between US and the rest of the world on multiple fronts. On growth cycles, because it will have a much larger positive growth shock in the US, potentially much tighter monetary conditions, because don't we think our best part of the disinflation in the US is potentially over, or at least it's stalled for now, which will prevent the Fed from being able to necessarily cut rates as much as is in the price or was being earlier expected. And you could argue even in terms of political cycles, with the US having gone past its event risk, while a lot of the rest of the world is still, is still dealing with political fragilities. On all these fronts, I think the gap between US and the rest of the world will widen, and to us, that should reflect itself in a stronger dollar. So no, I don't think the dollar rally is necessarily done with. Maybe in the near term, there is a little bit of a consolidation, but I think there is a lot more of this which needs to be priced in. Don't think Trump 2.0 is in the price on the dollar as yet.
Oh, okay. No, that's important. What's your sense, therefore, of fund flows? We saw about $2 billion move out of India in November itself, but then in October, 11 billion, I think 11.2 billion moved out because of our own results being subpar. Trump just added on. Do you think dollar flows are going to elude India? I'm not asking emerging markets because at the moment I'm more bothered about India.
So look, I mean, I'm no expert on equity flows, but let me think of it from a rate differential perspective.
Exactly.
I do think the gap in terms of, like I said, I think the quantum of easing the markets were anticipating from the Fed have already been tapered in response to both the fact that and in fact it said so in the FOMC minutes yesterday, the downside to the US economy is not really playing out as much. The concerns are not playing out as much as what was earlier expected, but also because, like I said, the anticipated shift in policy to us should be more inflationary and should probably warrant greater caution from the Fed in terms of how much easing it would do. So from a rate differential perspective, that gap versus India, and for that matter, the rest of the emerging market universe, but should certainly go more in favor of the dollar. And that should impact the flows which go away from the US and get reallocated into the rest of the world, at least initially. Now, of course, tariffs, its impact on what that matters for growth and inflation mix in the rest of the world is going to determine the sequencing, the timing, the quantum will all be very important. But I think till we have got past that hump, till we have got a greater bit of clarity on how that gets implemented, I think it's going to be hard for the rest of the world to be able to attract away flows from US assets.
Okay, so as long as the dollar remains strong, there will be US exceptionalism and people preferring the home bias, the home market, right? Okay, I've got a lot of questions now from what you answered. But first, what is your own estimate of how the US 10-year bond yield trajectory can be? This 4.5 that it threatened and then came back to 4.2. Does the higher yield still remain? And what is your estimate of the Fed's rate actions here on December and thereafter?
So I'll take the latter question first. Our house call is very much still for the possibility of one rate cut in December. We've thought for a while, and we continue to, that it's a closed call. And certainly the minutes from yesterday, I would argue, lean a little bit more in terms of the fact that there is probably a larger majority within the FOMC, which is also seeing things in a little bit more cautious manner than they were earlier, which makes this call even closer. But in general, we have one rate cut priced in. Either it will happen in December, maybe it gets pushed out to the first quarter. But to our mind, for now, that would be it. So we are looking at the Fed pausing at about 25 basis points from here and staying at that point at least through all of 25. Now, do we get into a condition where the Fed then resumes this in 26 and is able to cut rates more? We do think it will. But for the next 12 months, we are projecting only one more rate cut, and therefore potentially an environment for the next 12 months on rates which is a lot higher than what the market's pricing in on the Fed. Now, combined with the fact that, like I said, a mix of policies which is more expansionary on fiscal, potentially more inflationary as far as immigration is concerned, as far as tariffs are concerned, I would still think the combination of that positive demand shock and negative supply shock would therefore combine for a higher term premium in the US, and for rates, in our opinion, on 10-year US yields potentially peaking out closer to 475 rather than necessarily there. This is, of course, over the next few months. And like I said, it all depends upon the timing and sequencing of where a lot of these policies get implemented. When do we actually see a lot of these fiscal plans come through, both on tax cuts and additional spending? What exactly happens with tariffs? We've already seen some evidence that this could actually be this could be coming earlier in the administration than maybe what the market was anticipating. A lot of this, the timing and sequencing remains very unclear. The range of possibilities remain very wide. But in this uncertain space, the direction to us is still one for where dollars should be stronger and yields in the US higher, in our opinion.
No, if this is the ecosystem in which the Reserve Bank is operating, that dollar is likely to be stronger rather than weaker, and yields are likely to be higher rather than lower in the US, they are going to continue to keep fund outflows or pressure on the rupee as their base case. So what happens to rate cuts in India in that case?
So look, I'll start with the point of where India is different from a lot of other countries, especially in the emerging markets, which is that I would argue the Indian economy, and therefore the central bank as an extension, has more degrees of freedom. It's a much more domestically oriented economy. It depends a lot less on offshore capital flows than do typically most emerging markets. Its current account, while we suspect the gap could widen out a little bit next year, but is very largely under control, is something the net balance of payments deficit can be well controlled. There are adequate reserves, adequate measures, adequate ammunition which the central bank has to be able to control the market. So I think certainly more degrees of freedom. Now, can it be completely insulated, immune from the trend globally? Certainly, if we see a dollar to be stronger and rates to be higher, possibly not. But I would still say the rupee will, in my opinion, will outperform a lot of other emerging market currencies, would probably weaken versus the dollar. But I think the central bank would guide that in a much more calibrated fashion and to avoid undue volatility. And one where, yes, will the rupee be in the next 12 months weaker versus the dollar? We think it would be. That's what our global framework tells us, but by a lot less amount than what it probably will be in other EM currencies.
Okay. Now, finally, to bond flows. Up until September, we were celebrating the inclusion in the bond index, and practically every month we were getting about $1.5 to $2 billion on bond inflows from FPIs. A bit of it turned negative in November. It's slightly negative in November. So should we now think that tap is also closed, because that helped the Indian government a lot. The cost of raising money fell sharply to 6.75, the 10-year paper, from 7 quarter earlier this year. That's a big 0.5 percentage point fall in cost of money for the government of India. Is that over now? We should think that the bond...
I am inclined to think of it, Latha, as more of an interruption rather than necessarily a shift in trend. I think a lot of the FPI money coming into India was obviously a combination of both a structural trend as India's weight in GBI went up and therefore there needed to be exposure for global portfolios, but then also interrupted by what has obviously been a big shift in thought process around where the global cost of funds and particularly around core rates, US rates will move. I think that's where a little bit of this adjustment has come through. But again, I would think that the trend resumes in terms of, like I said, for India, which we consider as a market which is more defensive, more decorrelated compared with a lot of other EM, I don't see a reason why global investment portfolios, particularly ones which are benchmarked to the GBI index, would want to run any particularly large and underweight. It's a high-yielding currency which is largely decorrelated. I would imagine that most global investment portfolios would want to run market weight, maybe even slight overweight within an EM context on Indian fixed income next year. It does need more clarity. We need to appreciate that the uncertainty in how the growth inflation mix around the world moves next year is very high. So I think there will need to be those adjustments. But ultimately, I would still think India is a much better defensive and decorrelated trade in an environment of stronger dollar and higher rates.
Okay, I'm completely out of time. I've got a warning from my producer. Give me just two numbers. The rupee range for the next 6 months and Indian bond yield, 10-year yield.
So I'd say next 6 months, if our play goes out, I would say dollar rupee is about above 85. The bond yields, I would say it should stay well contained within 7%. Anything higher, I think is going to be more unsustainable, and we'll probably head lower down again from there. So I'd say 6.75, 7.
Okay, so that's very much the current range. Sameer Goel, it was a pleasure speaking with you. Thank you very much. Though you make a very scant appearance, a very rare appearance, thank you very much for joining us today and parsing the global fixed income and currency environment for us. Wrap up on Bazaar. Short post is coming up.